Greetings, I'm Andrew Ludwig and welcome to BLACK ONYX Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe that you, the investor, deserve to be better informed so as to achieve the best risk-adjusted returns. Today I'd like to introduce you to Murray Winckler. He's the co-founder of Laurium Capital, which was established in 2008. Murray, thank you very much for joining us today. Please tell us a little bit about your background and how you got into alternative investments.
Hi Andrew, yes. I started off, accountancy background, and then in the late 80s joined a stockbroking firm, Ivor Jones Roy, as an analyst, and progressed from there. We eventually sold out to Deutsche Bank. I spent 12 years in Deutsche Bank in various roles. And then in 2006, I guess it was, left and took a year and a half off sabbatical. And loved being on the sell side, investment banking, but then decided what I wanted to do. And took a while off and then looked around and was very keen to get onto the buy side. There were quite a lot of opportunities in the long-only space. But the hedge space always intrigued me. It's a lot more, technical and interesting. And it was a big industry globally. There's some $3 trillion of money in hedge funds. All the endowments in the States were invested in it. And in South Africa, it was a small industry, and I thought it would grow pretty strongly going forward.
Tell us about Laurium Capital and how the firm was formed and some of the funds that you represent.
So basically started up the business 2008, 6 weeks before the Lehman crisis, so not very clever. Got Gavin Forberg, who was also at Deutsche Bank for some 10 years, to come back from London. He was on the derivative structuring side and had been an analyst for many years. He came and joined me, and we managed to cobble together a bit of money. And at that stage, it was actually 100 million rand we got, some of our money and some of good mates, and started our first hedge fund, the long-short hedge fund. An average net exposure to markets is around 50%. So that's what we did. And shortly thereafter, we did a market neutral that didn't take any exposure to the market as well, about a year and a half later. And those were the two primarily funds that we ran. The assets steadily grew, probably not as quick as we thought, but they did grow. And then it must have been about 4 or 5 years later that we actually got into an aggressive version. A lot of the clients' markets were doing quite well. Our returns were decent, but they wanted more returns, more VUMA. And we started an aggressive version of our hedge funds. And so that was our foray into the hedge fund space. And what we did do was about 4.5 years ago, we got into the long-only space as well. And we started with a flexible unit trust, which is very much in line with, from our perspective, best suited to our skill set, being able to move our nets around quite a bit. And that's has steadily grown. And then the evolution of that was a couple of years later, we got requests from some institutions to do a fully invested Swiss mandate. So that was a pure equity fund, fully invested. And then another fund that we did do at a later stage is a Reg 28 fund, which is for pension funds.
Please give us your definition of a hedge fund.
Okay. Andrew, there are quite a lot of definitions out there of hedge funds, globally and then locally. FSB has a definition. But broadly speaking, it means you have the ability to sell shares, to sell short. And I'll get into that a little bit later. So that's the one big thing. And the second one is you're able to lever your positions, use gearing to gear up your returns. But on the risk side, I guess if you're managing risk, it could mean you could lose more money as well if you use gearing. But simply put, if you look on the shorting side, let's assume you were looking at the share Woolworths, which a year and a half ago was trading at around 90 Rand. You didn't like it. They've done a deal in Australia. David Jones, not great deal, and you thought the share was gonna go backwards or to fall. What we would do is then go and borrow the shares, so we didn't own them, and we would sell the stock short at 90 Rand and hope to buy it back at a lower price. If today you went out right now and bought Woolies, if we'd kept that position on, and we went to buy it back today, the share's trading at 55 Rand, we would have made the profit from the move from 90 down to 55, which is somewhere around 80% or so return. So that would be the ability to go out and short. So like a long-only player, we go out there and we buy shares we like. Shares that we don't like, we go and sell them short and hope to buy them back at a cheaper price. Okay, one of the other things I should also mention, hedge funds should be seen as complementary to other products out there. There's a lot of noise around passive these days, and I think in big developed markets like the US is very much so, passive is extremely good because it's very difficult to beat the S&P over time. When you get to smaller markets, then there's a lot more reason to have some active managers. You go into Africa particularly so, because not very well covered and a lot of opportunities there. But so passive is a place for passive in some of the very big markets in my view. Active also as well, big long only active managers. There's some very good guys out there. And then the hedge fund does something slightly different. So I think the three different strategies out there one should see as complementary. And one of the things is, if you look at Reg 28, even the pension funds, they say up to 10% can be put into hedge funds. So it's a small portion. We find that when you go into the when you go into the individual space, high net worth people, probably that percentage could be up to around the 20% of the overall assets sort of makes sense.
Murray, could you tell us a little bit about how Laurium Capital differs from other boutique managers and other mainstream and asset managers?
Okay, I guess if we look at our team, 11 on the investment side, a very strong operations team. Fundamental analysis, bottom-up fundamental analysis is what we do, which a lot of other people do out there. So I think we have a team of 12 people who are chartered accountants. That's not necessarily a good thing. 10 CFAs in the team, and by going out there, meeting management, doing business assessments, financial assessment and valuations, pretty core what everyone does out there. We do that, we think we do it very well, as good as everyone out there. So that's what we do, and that is core of what we do. Over and above that, what we do is I think we're pretty good coming from investment banking backgrounds, which is very different to a lot of the long-only asset managers out there or some of the hedge fund guys. We are very focused on event-driven special situations, and probably 20% of what we do is in that space. So any capital raises out there, we're very active, we play those extremely well, and we think we're able to add quite a lot of alpha from doing that. So that's one of the areas where I think we are quite different to everyone out there. And then the other area which we do is Africa. So we've done the rest of Africa since we started. There's a lot of alpha to be made in the rest of Africa, and by doing it, we have most of the analysts do South Africa and Africa, and it does help in the analysis of the South African companies, because a lot of them, if you take a Standard Bank, a Barclays, Nampax, MTNs, they all have operations in sub-Saharan Africa. And often the management you speak to in South Africa, generally always fairly bullish, but we get out there, we see what the operations are doing in Africa. We speak to the CEOs, CFOs in those countries, competitors out there, and then we can check up on what the management say here. And often the stories do not tie up. So that's a good thing, and I think that is quite a big differentiating factor. So by doing that over time, we've actually managed to, I think, also add quite a decent amount of alpha through that process.
How can investors access your funds?
Our three hedge funds locally, two of them are a retail fund, and as such you're able to come directly into the unit trust through Prescient, or you can come directly through us as well. What we do find is a lot of individuals go through Hollard, which is quite an attractive from a tax point of view, to go directly in through Hollard and into our funds. So those are the two main places that we find individuals coming into our funds at this stage. Now, we aren't on the platforms with the Momentums, the Nedbanks or the Glaciers at this stage, but that is one of the things that is being worked on for the industry, and we would imagine within the next 6 to 9 months or so, hedge funds will be available on platforms to come into our products. Our aggressive hedge fund is not a retail RIF, and it's really for qualified investors. So that is the amounts to come in. That is a lot higher, and you can still obviously come in directly through ourselves or through Hollard as well for that product there.
Thank you, Murray, for sharing the detail you have on Laurium Capital and your background. And thank you for tuning into Black Onyx. For more details, please visit our website.